Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. This week, 8th on the list for actively run funds is the equity collective Jupiter European. With regard to the fund's mandate, it is manager Alex Darwell's job to generate capital growth by investing in companies quoted on a European stock exchange. Fairly simple, at least in theory. Darwell's built a strong reputation for generating very strong gains and superior performance over time. He heads Jupiter's European team and has actually run this fund since January 2001 to great effect. The fund, for example, ranks 3rd out of 90 on a 3-year view, offers consistently good Sharpe ratios, and yet has a low beta of just 0.95 over that time period, so there is a clear focus on risk-adjusted returns. Besides this 3.2 billion sterling fund, Darwell also has responsibility for the equally successful Jupiter European Opportunities Investment Trust. That comes with a ticker JEO and has just under 700 million sterling in assets under management. Independent data providers show that overall Darwell's outperformed his peers 7 times in the last 10 years. Now, the fund and investment trust have the same mandate, and if you like Darwell's style, which one advisors and clients prefer will be a matter of taste. For the record, the investment trust at the moment unfortunately comes with a small 3% premium to net asset value, but the 11% gearing may appeal to some. The fund has a yield of 0.7% and an ongoing charge of 1.03%. The investment trust a yield of 0.6 and fees of 1.09, although the trust can come also with performance charges. So that's the nuts and bolts of Jupiter European Fund. The question to address is why advisors and clients might be interested now, barring that strong historic performance, which, as we know, is no guarantee for the future anyway. For me, there are 3 possible reasons why advisors and clients are looking at Europe and this fund in particular. First, the European Central Bank is still loosening monetary policy while the US is starting to raise interest rates and tighten it. Events since 2009 show that proactive central bank policy has tended to help asset prices, whether we like it or not. The US, UK and Japan are all further examples. Second, Europe is reasonable value relative to its history and very cheap relative to the US, again when compared to prior norms. Europe trades at around 11 times earnings compared to a long-run average of 12.5, according to work from equity strategy boutique Mirabaud, while a 35% valuation discount to the US is near historic highs and well above the post-1980 average of 16%. Mirabaud notes that Europe has traded at a similarly large discount 4 times in the last 35 years, and the gap closed to barely 10% each time. On 3 occasions, US equities went sideways while Europe went up, so American stocks don't need to collapse to close the gap, although, hands up, that is what happened during 1998 to 2001. The third and final case for Europe, well, it still has some very high quality, very well run companies capable of offering growth even when we're seemingly stuck in a low growth, low inflation world. And they're precisely the companies that Darwell seeks to target. At the time of writing, nearly half of the fund is weighted towards healthcare and technology, as this chart behind me shows, again to reaffirm the growth bias of the collective. Utilities and energy have no weighting at all, and the downtrodden basic materials segment represents just 7% of assets under management. By country, Germany is the largest weighting, followed by Denmark and then the Netherlands. Now, while Denmark may seem an odd choice for such a large overweight position, note that the nation was the best performing developed market worldwide in 2015 as benchmarked by its OMX index, helped by drug stock Novo Nordisk, which is Darwell's top holding in the fund. Other key positions stock-wise include Anglo-Dutch publisher RELX, formerly known as Reed Elsevier, Danish biotech player Novozymes, German medical equipment specialist Fresenius, and Italian eyewear leader Luxottica. This fund does of course have its risks. Western Europe is still teetering under a huge debt mountain and faces an immigration crisis, while it has yet to conclusively prove that Europe can make monetary union work in the absence of full fiscal and banking integration. The euro, as a result, continues to slide. However, seekers of capital growth with some downside protection from European valuations will take comfort from Darwell's long-term track record. So, thank you for watching. and I look forward to seeing you next time.